The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box Europe. I'm Steve Sedgwick with Ben Boulos, and these are your headlines. Europe's top 600 posts another record close as speculation swirls over a choreographed change of the guard at the ECB. Wall Street also in the green, even as Fed minutes show that rate cuts will likely stay on pause for the near term. The Microsoft president Brad Smith telling CNBC that US and European firms should be on guard in the face of rising Chinese competition in the AI space as the AI Impact Summit continues in New Delhi.
I do think we always have to think about, maybe even worry a little bit, about Chinese subsidies. I mean, that was the fundamental approach that China successfully took to disrupt the telecommunications market.
Crude prices surge, ending Wednesday's session 4% higher as concerns grow over the possibility of US intervention in Iran, despite some progress in talks in Geneva. Nestlé posts stronger than expected sales growth in the fourth quarter and announces plans to consolidate its product portfolio as it looks to turn its fortunes around.
Ben, a lot of people think that they don't like what I say on the CNBC. They think it's too contentious. They think I shouldn't say what I say, or actually I'm downright wrong. They are totally allowed to have those opinions.
Who are these people?
Well, I don't know. They exist. They might be watching Bloom. They might be watching my friend Guy Johnson as we speak. They might be watching your old lot, the BBC, as we speak, thinking they're going to get a better view on the news flow in terms of a business, politics, markets perspective. But the fact of the matter is, very few of those people who think I'm rubbish out there think, do you know what, I need to discipline Sedgwick for saying something different from what I think about the market. Should I be disciplined because I say something that may be factually correct, but is different from the view, which is the mainstream, different from the view that, dare I say, even the government wants to hear as well? I don't know where that sits. In fact, I do know where that sits personally, but everyone's allowed their own opinion because we live in a free, liberal democracy as well.
What it comes down to is your opinion based on robust, factually researched information. And if it is, then it's entirely all right to put your opinion out there.
My understanding, you are quite right there, the data that the Kiel Institute, that the New York Federal Reserve and others have crunched is accurate when they say that 90% of the costs from tariffs are being passed on to consumers or to the companies who are making the imports. Come back to this in a couple of moments' time because I've just got to get to this really.
Please do, because I've got some points to make on this a bit later.
Do you know what? Let's rev up the rundown. Who cares? Do it now.
Well, the comments from Hassett, it strikes me, you can criticise a report, you can say, no, it's, it's the worst paper I've ever read in the history of the Federal Reserve System. You can say all of that. You can say, no, prices are not being passed on to consumers. But the reality is, if people's lived experience tells them that when they go to the shops and they buy things, they have got more expensive, then you can argue that black is white. But if that doesn't relate to what people's experience is in the shops, well, people are going to draw their own conclusions, aren't they?
Right, so this comes on the back of the fact that the director of the National Economic Council, Kevin Hassett, has said that economists at the New York Fed should be, quote, disciplined for the release of a report highlighting that US businesses and consumers were shouldering the majority of the costs of President Trump's tariffs. Speaking to CNBC yesterday, speaking to our Squawk Box yesterday, he called the report the worst he's ever seen in the history of the Federal Reserve System, saying that the conclusions are highly partisan and failed to capture the full effects of the president's tariff. But they are facts. Facts are facts. They're not necessarily partisan, non-partisan. Facts are facts, sir.
Can I just say, in fairness to him, he fleshed out his argument, which was that you need to factor in wage rises.
Yes.
Now, yeah, that's fair enough.
He's not asking about wage rises.
No, but he's saying they should have factored in wage rises.
Why? They are looking at the exact costs of those imports. Who is paying the cost? He's not asking about the derivative effect of that. He's not asking about the fact that it's making America more competitive or more productive potentially, and we're substituting cheap Chinese goods for more expensive American goods that are creating American jobs that potentially create. That wasn't the point of the survey. The survey was looking at who is shouldering the costs of those imports.
And I agree with you. But I think if his point is that to give the full context, you need to factor in the wage rises that have come from bringing some production back into the US, then that's all fine. But
that's
don't
not what the survey was
exactly
doing.
Commission another survey and then add that to the argument. But it's created quite a row.
Well, for those of us who are worried about the independence of central banks. Speaking to CNBC yesterday, he called the report the worst he's ever seen in the history of the Federal Reserve System.
The paper is an embarrassment. It's, I think, the worst paper I've ever seen in the history of the Federal Reserve System. The people associated with this paper should presumably be disciplined because what they've done is they've put out a conclusion which has created a lot of news that's highly partisan based on analysis that wouldn't be accepted in a first semester econ class. The bottom line is that if you're wondering like who bears the burden of something, of a tariff, then you remember, Joe, you got supply curves, demand curves, you shift them around, you got consumer surplus, you got producer surplus, and then you look and see how it all works out in the end. And they're basically only looking at changes in prices. So they're assuming that quantities don't move at all. But guess what? Quantities did move at all.
All right. Well, they were looking at specific things. That's fine. I'm not saying Hassett should be disciplined because he's looked at the wider remit. They looked at a specific remit. They were very clear in their report what they looked at. But disciplining them, that's the problem, I guess. Not the fact that they said something and he said something, and great. You know what, Hassett's absolutely right, as Ben said, to have his view on this one as well. But disciplining people because they looked at a certain subset? Federal Reserve officials are divided on the future path for interest rates, with some open to a rate hike if inflation remains elevated, according to the minutes from the last Federal Reserve meeting. Policymakers caution that whilst expected to fall, it is progressing at a slower and more uneven pace than anticipated. Let's get to the markets.
Yes, and that was one of the factors that investors were weighing up those minutes from the Fed, as Steve was mentioning. The S&P moving higher on Wednesday, supported by gains in technology stocks and video shares advancing 1.6%. In fact, this was after Meta announced it's going to use millions of NVIDIA's chips in its data center build-outs. Amazon stock also moving higher by nearly 2%. That's snapping, the day before it had snapped a 9-day losing streak. Generally, though, a fairly muted session. The major averages only eking out relatively small gains. The software sector is worth looking at, already been under pressure due to fears of the disruption from artificial intelligence. Interesting moves on the oil price. Oil jumping in response to the latest developments in those talks in Geneva. This is after Vice President J.D. Vance said that Iran had failed to address US red lines in this week's nuclear talks, and stressing that military action still a possibility. So concerns around that fueling a rise in the oil price. You can see there the week-to-date performance. Let's have a look at Asian markets. Trade somewhat thinner there this week. Some of the main markets closed for the Lunar New Year holiday, Hong Kong and mainland China. The others worth focusing in on South Korea's Kospi because it touched a record high on Thursday as the region tracked those gains that we saw on Wall Street. The Kospi benefiting from heavyweights, Samsung Electronics and SK Hynix increasing their value. Goldman Sachs highlighted in a recent note, just to pick out the Kospi, after nearly doubling in 2025, Korea is again the leading market in Asia Pacific. The bank's forecasting 120% growth for Korean equities in 2026.
How much?
They're forecasting 120% growth for Korean equity markets in 2026. This is off the back of a rise of 36% in 2025. I know, I had to read it twice, but that's their forecast. They stress...
Really?
Well,
126% up?
120% growth after 36% growth in 2025. I will double check that for you. I did double check it. I triple checked it. unless I've had a...
I'm a little bit bemused, I've got to be honest. Didn't check the data myself, but it just sounds a big number to me.
Let me go back and double check it. I will triple check
have a little look.
in case I've had
I'll have a little look. I don't know many calls like that in the world. I've got to be brutally honest.
Thank you for spotting it. Let me go. I will check it.
I bet you're really glad I spotted it.
I am very glad you spotted it, because
let's move on. We've got a brilliant guest.
If my finger...
We don't need to go on about this.
My finger slips on the keyboard, I will correct it.
I'm going to guess you might have overdone that one.
Let me check. Let me check.
Okay,
I'll come back to you on that one. Let's have a look at the European futures, expecting a fairly mixed open after a strong performance. The Stoxx 600 yesterday ending at 1.2%.
Now, we've got a brilliant guest now, and I'm pretty sure this brilliant guest does not want me to talk about whether Hassett is right or not. And I'm not going to, don't worry, Kathy Clay, who is the CEO of S&P Dow Jones Indices. Lovely to see you. How are you?
It's so great to be with you this morning. I'm well. Thanks for having me.
Yeah, there's a lot going on. Hey, look, regardless of economic policy, and I'm not going to get you embroiled in Hassett versus the New York Fed, unless you want to go there.
No, thank you.
No, I thought not. Okay, but look, what is unambiguous is that the markets, by and large, are doing pretty well at the moment. Kathy, I'm ancient. I'm so old. I just checked what the Dow level was when I started in the city. It was 2000.
2000?
2000. 1988, but don't tell anyone.
I won't tell.
So look, the indices are doing really, really well at the moment. What are the massive challenges that you're confronting?
Yeah, I think, if you're casually looking at the headlines, you might think that the U.S. equity markets is taking a bloodbath. But it's actually not the case, right? And I think, when you look at the near-term price action, it's helpful to put what we're seeing in the U.S. markets into a little bit of historical context. So if we look at the 3-year period ending 2025, we saw the S&P 500 up 86%. So a nice bull market.
Not as much as that market that Ben's talking about.
Yeah, they didn't compare to that, Ben.
I have just double-checked it, and there it is on CNBC's own website. The investment bank forecasts 120% growth for Korean equity markets in 2026.
I think it's wrong.
Okay, we'll go back and check.
The debate will continue on the matter, I can tell. But, back in the U.S., if you look at the S&P 500 top 10 out of the 500, that returned 188% over that 3-year period.
That's extraordinary.
And so it was a great bull market, but it really was a mega cap stampede. And when you really look at the constituents of the S&P 500 over that 3-year period, only 19% of the constituents outperformed the index. And you saw the S&P 500 equal weight performing only at 34%. But now look at the story coming into 2026. We see the S&P 500 slightly up on the year, but we see the equal weight index up 6% on the year. And we see 66% of the constituents outperforming the index.
You sound relieved. And do you know what I think you sound relieved? I'm kind of creating a narrative here. I think you're relieved because there's a lot of people out there who have criticised the weightings of these massive technology companies out there and saying, look, the S&P is just a barometer of 7 companies, maybe 8 companies as well. And I think this diversification that we're seeing so far in 2026, I think it's left a lot of people, certainly index providers, a bit more relieved the fact that there is diversification going on. And also answering the question, how will the market perform when the Mag 7 doesn't?
Yeah. Well, I think it also provides some comfort to investors who might have been getting a little bit uncomfortable with the concentration theme. And the concentration theme was clearly the theme du jour of the last 3 years. And now we see what looks like a much more broadening across different asset classes and even geographies. I mean, the Kospi, we'll see what the return is going to be, but that's a big headline. But it's not just Kospi, it's Japan is performing well. Even UK has a strong start to the year. So I think it is a more well-balanced story that we're telling. It's early days. We're just a month and a half into 2026, so we can't make conclusions right now. But we do see a broadening as a thematic heading into 2026.
Kathy, what role do you see AI playing in indexing in your world?
Yeah, I mean, we, and broadly across S&P Global, we see AI as an enabler to help our processes be more efficient, to help our workforce be more productive. There is a role for AI in indexing, but the Dow didn't hit 50,000 on February 6th without really paying attention to what we hold dear, which is transparent methodologies, which is strong index committee governance. Those are the things that stand the test of time. And so we'll be very careful using AI in the appropriate ways in indexing.
Forgive me if this is too simplistic a question, but it occurred to me, I was thinking about this chat. How do indexing companies like yours survive in a world where AI could potentially disrupt that whole business model? Because someone could go to any LLM and say, draw me up a list based on publicly available information from official sources of the biggest companies by market cap and create an index for me that I can track. What is it that companies like yours still offer that people can't get from those kind of models?
Trust. Let's go back to the Dow. This is an index that was created and started calculating in 1896 with 12 stocks. This index has been a barometer of the U.S. economy through wars, through financial crises, through many new presidential administrations. And so it's a barometer of trust. And so that's what AI is not going to deliver without human intervention in the process. The fact that we have index committees and strong governance, that allows us and have the privilege of bringing trusted benchmarks and barometers to the markets.
And do you have those conversations among yourselves and your colleagues about how you stay relevant and how you ensure that people out there retain that trust and it's seen as a key selling point?
Well, I don't think we even question that we stay relevant. And I'll push back on that a little bit because I think in this world we live in today, trust maybe is a fragile concept. And I think the fact that we're delivering trusted benchmarks that value performance, relative performance, and stand true to what it's supposed to measure is something that will stand the test of time, as the Dow has proven.
Kathy, I know some of your peers in Europe as well, and their major line of defence against AI incursion, which basically stripping out their data and perhaps not giving them the benefit back, is the fact that it's their data. You have a serious amount of data at your disposal as well. How do you make sure that you own the profits from that going forward rather than the AI companies?
Yeah, I mean, we own a lot of proprietary data, and we use the proprietary data in ways across S&P Global, by the way, to deliver these benchmarks and trusted sources that folks can rely on. We're just going to continue to do what we've always done, and we believe that doing what we do will stand the long arc of time, and we'll continue to make sure that our proprietary data is treated in the proper ways and properly licensed so that people can have the benefit of what we deliver as insights into the economy.
Super duper. Kathy, lovely to see you. Thank you very much indeed for joining us.
Thank you.
Question.
I know, because we've got a CEO waiting in the wings as well.
I'm just going to quickly say, what's the best thing about the job so far? You were appointed last year. Highlight?
The best thing about the job is really the team and the clients I've met with, and really the value that our clients find in what we're delivering to the marketplace.
Not having to comment on Kevin Hassett. Okay, I'll leave that.
Okay.
Thanks, Kathy.
Thank you.
You did well there, don't worry.
You.
I wasn't going to go near that.
Okay.
Kathy Clay, thanks very much indeed for that. CEO of S&P Dow Jones Indices. 120% earnings growth, not 120% increase in the index.
Thank you for clarifying.
No worries. Let's move on.
Clarifying. Yes, let's move on indeed. Coming up on the show, Nestlé beats sales expectations, but earnings are overshadowed by a baby formula recall. Karen Roth has the story for us. Plus, President Trump reconvenes his Board of Peace in Washington today. Dan joins us with a preview. And we're live in New Delhi for the AI Impact Summit. We'll speak exclusively to Qualcomm CEO Cristiano Amon at 9:45 London time.
I'm Steve Sedgwick from CNBC, and in my new podcast, Executive Decisions, I ask powerful leaders about their decisions that changed everything.
I'm not frightened of making tough decisions, and I think leadership can be very lonely.
Business leaders should not stay quiet in a world which is super complex.
It is absolutely fine to also change your mind.
Tough calls, personal crossroads. These are the stories that we can all learn from. It's Executive Decisions from CNBC. Get it wherever you get your podcasts.
Zurich Insurance has topped annual operating profit expectations, posting $8.86 billion as the insurer was boosted by gains in its property and casualty unit. The Swiss group said it had achieved record net income attributable to shareholders of $6.8 billion, with CEO Mario Greco saying the business is on track to potentially exceed its 2027 targets. Well, Mario joins us now. He's the CEO of Zurich. Very good to see you. Just run us through the numbers and what you put that performance down to.
The numbers are incredibly strong across the board. Property and casualty contributed with the best result ever, but life, farmers equally contribute very strongly. We also have a record loyalty from our customers. which is a very, very rewarding sign of trust and high service and appreciation of our high services from the customers. So this is really a strong start for us into 2026, which is the mid-year of our 3-year plan, and this is why we indicated that we have confidence on hitting or even exceeding the 27 targets.
Just tell us about where things are up to with the bid to buy Beazley and the strategic importance of that and having a presence in the London insurance market.
Yeah, look, since 2016, so a while ago, we've been growing the specialty business. Over the years, we kept investing, we kept developing our skills, our expertise. Today, we roughly have 9 billion of revenues in the specialty products. And for us, the leading contribution comes from construction infrastructures, where, especially in the US, we have fantastic skills and experience, and definitely also the AI development has supported us. We've been working last year over more than 200 data center building constructions in the US, insuring them. So we have massive knowledge on that. Now, specialty is a highly skilled area of the industry, where with Beazley we think we can combine and acquire skills that we need and that otherwise it would have taken years to recruit them in the markets. And so it is the execution of a long-term strategy of growing the specialty portfolio in our books.
Mario, really good to see you today, sir. You own the data. It is your data that a lot of these AI players are desperate to get hold of so they can improve their models as well. It's a two-way stretch. Is it possible, though, to hold the line and actually make them pay for your data?
I would say it is possible, but it's not interesting for us. We want to keep our customers' data for ourselves to serve the customers better. The more we use the data, the more we understand the data, the more focused and tailored our offer to the customer will be. And so we don't plan to sell our data to anybody else than to use them for the customer's benefits.
In terms of, I'll move on from that, Mario, because I think you've covered it well enough now. In terms of what's going on with the Beazley $10 billion takeover as well, 56% premium was before the closing price. Beazley initially rejecting. Where are we at now, Mario?
We had a joint statement some 10 days ago from Beazley and ourselves for an agreed level of offer to Beazley shareholder, and the recommendation from Beazley board to the shareholders of Beazley to accept our offer, and we're currently doing due diligence. And then we will see through the due diligence if nothing emerges, then we will go in the next steps, which is the formalization of an offer.
Why does this deal make sense for you? It's been a long pursuit, Mario. They've kind of tried to hold out for a higher price, and as you say, eventually they've come round to the agreement that it is an acquisition that they are willing to accept. Why is this a good deal for Zurich?
It is a very complementary set of skills to the one we have in the specialty world, and we think that we can boost their sales, their growth by opening our distribution channels to their products. And on the other side, I think our customers can benefit a lot from having an access to their products. So I think strategically, this is a very strong deal for us, but also for Beazley. The financials, let's talk about the financials. If we will make a formal offer, then we will explain what is the financial reason to do the deal.
Mario, you said that the business is on track to potentially exceed its 2027 targets. What are the potential challenges, headwinds that you'll have to tackle in order to achieve that?
Look, looking at the news every day, I think we're full of challenges every day, but our business is incredibly agile and flexible, and we have been able last year, as in the past years, to quickly move ourselves and find the opportunities that still exist in these markets. I think we need to remain agile and fast and flexible, and with that, I think we have all the capital strength, the liquidity supporting us to develop ourselves where the opportunities are. This is a situation in the markets where there are lots of opportunities. Yes, there are lots of challenges, and they're all very visible. But there are many opportunities out there, and in 2025, we've been quite good at catching these opportunities. The game for 26 and 27 is to continue doing that. It's not easy. I mean, you cannot just go straight. You have to quickly react to what's happening. But there is customers are in need of support by insurance services. We have the skills to support them. We have the trust of the customers. We have the reputation. I see the possibility for us to truly deliver 27 and possibly exceed that.
Mario, very good to speak to you. Plenty more questions for next time stored up still, but nice to see you and nice to see the results. Thank you very much indeed for that. Mario Greco, CEO of Zurich Insurance. Let's get out to India, where at the AI Impact Summit we can hear what Sam Altman has to say.
Concerned about the long-term future. Technology always disrupts jobs. We always find new and better things to do. The people of 500 years ago would have thought that our current jobs often look silly, like ways to entertain ourselves, create stress. And the people 500 years from now hopefully will look at us, hopefully look to us, like impossibly rich people playing games, trying to find ways to pass their times. But we should all hope that they feel much more fulfilled than we do today. I'm confident we will keep being driven to be useful to each other, to express our creativity, to gain status, to compete, and much more. But the specifics of what we do day to day will probably look very different. Each generation has built on the work of the generations before. And with new tools, the scaffolding gets a little taller. This collective external lattice, the set of tools that we have built up around ourselves, is remarkable. And we are capable of doing things that our great-great-grandparents couldn't have dreamed possible. It is a moral imperative to make sure that our great-great-grandchildren can say the same. And technology, and especially AI, is how we're going to get there. For a democratic AI future, it is not enough to just give people tools and wealth. We also need to give them agency and power. The vision that AI companies lay out fundamentally reduced to either unilateral control or decentralized power. Sharing control means accepting that some things are going to go wrong in exchange for not having one thing go mega wrong, cemented totalitarian control. This is a fundamental trade-off of democracy, and it is one that we believe in very strongly as the way to give everyone collective agency over the future. Of course, this is not to suggest that we won't need any regulation or safeguards. We obviously do urgently, like we have for other powerful technologies. In particular, we expect the world may need something like the IAEA for international coordination of AI, and especially for it to have the ability to rapidly respond to changing circumstances. The next few years will test global society as this technology continues to improve at a rapid pace. We can choose to either empower people or concentrate power. Thank you very much.